Welcome to the end of the IFRS Spotlight with Tojo Samuel. In today's episode, we'll be discussing accounting and taxation implication of borrowing costs. Accounting and tax implications of borrowing cost. Borrowing cost is one of the transaction or set of financial activities covered under IFRS. It is covered under IAS 23, titled borrowing cost. The principle about IAS 23 is for borrowing costs incurred by an entity, what portion or what nature of borrowing costs are capitalized and what portion or nature of borrowing costs are expensed. That is the core principle, that is the core consideration of IAS 23. The core principle is borrowing costs incurred on the acquisition, construction, or purchase of qualifying assets are capitalized as part of the cost of that asset. All other borrowing costs that do not qualify for capitalization are expensed. That is the core principle, the summary provision of IAS 23. So what is borrowing cost, or what are borrowing costs? Borrowing costs are interest expense and other costs incurred in connection with the borrowing of funds. Borrowing costs are interest expense and other costs incurred in connection with the borrowing of funds. When an entity goes out to borrow funding or takes a loan or takes a facility or takes a credit, it incurs certain costs of funding associated with such borrowing. Such costs of funding associated or necessitated by borrowing are referred to as borrowing costs. So when are borrowing costs capitalized? Or when can a particular borrowing cost be capitalized as part of the cost of an asset? IAS 23 provides a term referred to as qualifying asset. It is only a borrowing cost or a set of borrowing costs associated with qualifying assets that are capitalized. If a borrowing cost is not associated with the purchase, acquisition, or construction of a qualifying asset, such borrowing costs or costs are not capitalized, they are expensed. So the question is, what are qualifying assets? That is those assets, so which we have just said, that when borrowing costs are incurred with respect to the purchase, acquisition, or construction, such borrowing costs are capitalized as part of the cost of such assets. So what are those qualifying assets? IAS 23 defines qualifying assets are those assets that necessarily take substantial period of time for them to be made ready or for them to be ready or prepared to be available for use or for sale. Qualifying assets are those assets that necessarily take substantial period of time for them to be prepared or ready to be made ready for use or for sale. Those are qualifying assets. So only those assets that take a substantial period of time, that do not take a short period of time to be prepared, to be constructed, or to be made available to be ready for use or for sale, those assets are called qualifying assets. And it is on those category of assets that any borrowing costs incurred associated with such assets are capitalized. Within the scope of IAS 23, some items are specifically left out as being assets that do not qualify to be considered as qualifying assets. One of the class of assets are any asset measured at fair value. Any asset measured at fair value does not come within the ambit or scope of assets that are considered qualifying assets for the purpose of capitalization. Secondly, inventory produced in large quantity in a repetitive basis. Large quantity production in a repetitive basis do not qualify as qualifying assets. So not all inventories, those inventories that are produced in large quantity and on a repetitive basis do not qualify as assets. So they do not come under as qualifying assets. So these are the two broad sets of assets that do not come within. those assets that are measured at fair value and inventories that are manufactured or produced in large quantities on a repetitive basis do not come under as qualifying assets. So they are not qualifying assets. So other assets that do not fall within this broad scale may qualify as qualifying assets upon which borrowing costs are capitalized. With respect to the definition of borrowing costs, because we refer to those costs as the interest expense and other costs incurred with respect to borrowing of funds. Equity costs are whether actual imputed equity funding are not within the consideration of borrowing costs under IAS 23. In other words, cost of calculated actual or imputed cost of equity, cost of fund of equity, or anything classified as a component of equity do not come within the cost consideration as borrowing costs. They do not, under the scope of IAS 23. So we are taking it down. We've defined what borrowing costs are, that there are all those the interest expense and those costs incurred with respect to borrowing. We've defined what qualifying assets are, those assets that necessarily take substantial period of time for them to be ready for use or for sale. Those are qualifying assets. So basically, we're going to have a whole lot of items under property, plant, and equipment qualifying as a qualifying asset when they are not measured at fair value and they are constructed, purchased, or take certain period of time for them to be ready for the intended use, the way they are intended to be used by management. So there must be a substantiality to the time frame taken to get them ready for use in case of this item of property, plant, and equipment. Investment properties that are not measured at fair value can qualify as qualifying assets. Inventories of special nature that are not produced in large quantity on a repetitive basis will qualify as qualifying assets. Plants, infrastructure, factory, all of these categories of items will qualify as qualifying assets upon which associated borrowing costs can be capitalized as part of that cost. These are examples. Now, what costs are eligible for capitalization? What costs are eligible for capitalization under the borrowing cost consideration? So those funding costs associated with the deployment of that fund in either the purchase, acquisition, or construction of an item that is a qualifying asset are the eligible costs for capitalization. When an entity goes out to take a term loan, and that entity is charged, say, 15% or 20% for that term loan, which is used to construct a factory, that interest charged by the bank, for example, is the cost added as part of the cost of the factory, the cost of expenditure spent on the factory as part of the carrying cost of that factory. That is capitalization. However, we need to be careful. Under IFRS, when we talk about interest expense, we mean interest expense measured using the effective interest rates. We mean effective interest rate measured interest expense, not the contractual interest rate stated on the term sheet, not the legal fee stated on an offer letter of a loan. It is the effective interest rate. So the effective interest rate is always different from the contractual interest rate for a long-term loan. Effective interest rate is always different from the contractual interest rate for a long-term loan. Why? Because in the typical processing of transaction or loan or facility sourcing, there are certain upfront fees that are often incurred. Fees like processing fee, management fee, availment fee, legal fee, and the rest. All of these costs are incurred in the process of borrowing a loan. So when the interest expense is calculated using the EIR method, that is the effective interest rate method, all of these costs, these upfront costs, processing, management, availment, legal fee, syndication fee, whatever they may be called, all of this upfront fee and even other quarterly fee are considered in estimating the effective interest rate. The effective interest rate, in essence, is internal rate of return. When a loan is given, payments are to be made periodically over a period beyond 1 year or beyond 12 months. Those future instrumental payments are considered as the cash flows. Cash flows. They are considered as the cash flows, cash inflow. And the core loan made available is considered as cash outflow. All the upfront fees incurred, processing, management, availment, lending, syndication, legal, all of those fees are also considered as outflow. So under the EIR, it is determining the internal rate of return by a matching discounting of the cash outflow and the inflow in such a way that the net amount will be nil. In other words, what interest rate will discount the future cash flow, bring it into a present value that will equate the principal, the net loan given to an entity? If the net loan, if the nominal loan given to an entity is 20 million, and all the upfront fees incurred, all the upfront fees are 1 million. So the net loan given to that entity is not 20 million, is 19 million. And an interest repayment schedule has been given that shows instrumental payments that will be made over the years. The discounting of those instrumental payments to be made and the upfront discounting of the upfront fees made should, whenever it gives an amount that equates the net loan taken, 19 million in this case, when the discounting of these instrumental payments and the upfront fees made, when the discounting gives us an amount, that rate that makes it give an amount that equates the net loan from the outset, 19 million in this case, that interest rate is referred to as the effective interest rate. And what does effective interest rate do? What does it do? Effective interest rate enables the spreading out of all financing or borrowing costs associated with a lending or borrowing. It enables the evening out. So the amount of a loan or the amount at the end of a reporting period is called the amortized cost. The amortized cost, meaning there's an effective interest rate that has evened out, that has equated the periodic consumption of the funding or interest expense. So that's what EIR is about. Therefore, wherever the borrowing cost, we mean that interest expense as determined using the effective interest rate. Borrowing cost will also mean the finance charges or the finance expense incurred by a lessee in a finance lease. For a lessee in a finance lease, the financial charges, the financial premium, the financial instrumental expense associated with the finance lease also constitutes a borrowing cost. So we've mentioned the interest expense as determined using the effective interest rate method. We've mentioned the financial charges or finance charges associated with the finance lease from perspective of the lessee. Thirdly, any foreign exchange rate impact associated with the base interest or lease charge forms also a component of the borrowing cost. So that is about the nomenclature or the component of what is or what are borrowing costs. And we say the portion eligible, right, is the borrowing cost associated with the given loan. So when you take a loan of 3%, for example, other fees are there. When the effective interest rate is estimated, that rate is the borrowing cost eligible to be capitalized. That takes us to the issue. What happens when an entity takes a pool of loans? And out of that pool of loans, those pool of loans are used for different purposes, probably to buy a qualifying asset, to purchase or to construct a qualifying asset. How is the capitalization rate determined? So under IAS 23, the concept of weighted average of borrowing cost comes up. Weighted average of borrowing cost comes up. That concept comes up. In other words, it's like the average cost of borrowing. It is referred to as the capitalization rate. Assume an entity takes a loan of 10 million at 5% interest rate, takes another facility at 15 million at 10% interest rate. Two different credit facilities. One is 10 million at 5% interest rate. Another is 15 million at 10% interest rate. How is the capitalization rate determined? Because this 25 million naira loan, the first one is 10 million, the second one is 15 million. The total loan, 25 million. But these loans are used for diverse purposes, both for the construction on one hand, both for working capital, both for bridge financing and all of that. So how is the rate determined? How is the rate? That rate that will be used in determining the borrowing cost associated with that portion of fund deployed in constructing an asset, for example. How is that interest rate, that borrowing cost determined? That is the concept behind the weighted average of borrowing cost. So the weighted average cost of borrowing is determined. In the example we've just given, 5% of 10 million is going to translate to 500,000 naira. 5% of 10 million is going to translate into 500,000 naira. 10% of 15 million. 10% of 15 million is going to translate into 1.5 million. So the summation of this interest expense, for example, this borrowing cost, for example, the 500,000 from the 10 million and the 1.5 million from the 15 million will total 2 million. So 2 million being the numerator all over the total fund, which is 25 million. There's the 10 million and there's the 15 million, the total 25 million. And the summation of the interest expense, the 500,000 plus the 1.5 will give you a 2 million. So 2 million all over 25 million multiplied by 100 will give them 8%. Just say 2 over 25 times 100. So that is 4 times, that's 8%. So in that case, 8% becomes the capitalization rate. In other words, for all spending incurred out of that 25 million naira pool of fund used for diverse purposes, for the portion spent or expended on the qualifying asset or item, 8% to be used to multiply that spending to determine the borrowing cost. That is what happened where there is general fund or general borrowing or borrowing for various purposes from which part of the fund is used for the acquisition, purchase or construction of a qualifying asset. So the weighted average of the borrowing cost, which is the capitalization rate, is used to multiply the spending incurred for that fund deployed toward the relevant assets, toward the relevant qualifying assets. That is how eligible cost for capitalization is determined from a pool of general fund. But for the specific one, it is that specific effective interest rate measured expense that is used to determine the associated borrowing cost. As at when does an entity begin to capitalize borrowing cost? What is the timing for the commencement of recognition of borrowing cost? The standards say it has the commencement date. An entity begins to capitalize borrowing costs from a commencement date. And IAS 23 explains that a commencement date is a date where 3 conditions are met. Number 1, the entity incurs expenditure towards the construction or acquisition of the asset. The entity incurs the borrowing cost actually, and the entity takes all steps necessary or engages in the activities necessary to get the asset ready for its intended use or sale. These 3 conditions must be met concurrently before an entity begins to capitalize borrowing cost. 1, the expenditure must be made. The associated cost of borrowing for that spending must be incurred, which must begin to run. Thirdly, the entity also engage in all activities necessary to get that qualifying asset ready for either its intended use or for its intended sale. An item of inventory will qualify for intended sale, while all others will be to get them ready for their intended use. So these 3 conditions must be met. When these 3 conditions are met of incurring the expenditure, incurring the borrowing cost itself, and taking or engaging or getting involved in all activities necessary to get the assets ready for a use or sale. It is at this date, when these two conditions are met, that capitalization commences. It is also possible that in the process of construction, there may be interruption. When there are interruptions that prevent or inhibit the continuation of construction, what happens to the borrowing cost that arises within that period? Let's say there's an order from the government to suspend construction at a site, for example, or there's a picketing by a labor union, or there's a downtooling that the workers at site, or there's a massive flood that disrupts continuation of construction, which is irregular in that region or in that industry. These are interruptions. Or probably there's a fire outbreak that goes a section of a building of a project that prevents continuation until certain integrity assessment is made to ascertain whether to continue and what form to continue as. All of these interruptions we need to what we call the need for any borrowing cost within that period of interruption to be suspended. So IAS 23 recognizes the concept of the need to suspend capitalization. In other words, during this period of interruptions, all borrowing costs that arise, the borrowing costs arising within this period, are not capitalized as part of that item. They are rather expensed. They are expensed just like those borrowing costs that do not qualify for capitalization. That is suspension of capitalization. Then what happens when an entity concludes the construction, or is done with the purchase, transport, and getting the qualifying asset ready for its intended use or sale? What happens? The standard provides that borrowing cost is ceased. There is a cessation of borrowing cost. So the standard explains that when an activity is substantially concluded, when a construction, when a purchase, when an acquisition is substantially, the underlying word is substantially concluded or completed, borrowing cost ceases to be capitalized. Now, when does this happen? For example, a building is constructed and the engineer or the builder are removing the scaffold, for example. They are moving the scaffold, they are cleaning all of the work tools, emptying all of the rooms, all of the temporary storage rooms, and all of that. At those stages, the work is completed. So engaging those minors makeup or administrative duty to get it usable in its aesthetic need are no longer part of the core construction process. Hence the word substantial completion. When an asset is substantially completed and ready for its intended use or sale, any borrowing cost ceases to be capitalized. They are all expensed, just as they are done for those costs arising within period of interruption when capitalization is suspended, and as it is also done for those borrowing costs that are now incurred on qualifying assets. So this is the accounting implication of borrowing costs under IAS 23. For disclosure in financial statements, an entity is required to disclose that portion of borrowing costs that is or that are capitalized. That portion, whether it is included in building, in plant, in infrastructure, in a power system, in whatsoever, wherever that item upon which borrowing cost is capitalized, the standard requires that disclosure is made that this portion of this item, of this qualifying asset, is the portion arising as a result of the borrowing cost. So the standard requires such disclosure, number one. Number two, when a general pool of fund is used from which spending is incurred to acquire, to purchase, or construct a qualifying asset, the standard requires that entity discloses its capitalization rates. The capitalization rate. So out of all those various sources of funding, an entity is required to disclose the capitalization rates arrived at by consideration of the various pooling of funds and the average, in quotes, cost of borrowing. So these are the two core disclosure required with respect to borrowing costs under IAS 23. Then for the tax implication in Nigeria, in line with the circular issued by the Federal Inland Revenue Service in 2013, any borrowing cost incurred for purchase or acquisition does not qualify as part of the cost of an item on which capital allowance will be granted. When an entity takes a loan or make a purchase, and ordinarily are taking that loan to make a purchase or construction, to make a purchase or acquisition of an item of QCE, ordinarily, that entity will have capitalized the cost of the borrowing together with the base cost of that item in line with IAS 23. However, in line with the circular issued by IFRS, such borrowing costs incurred for the purchase or acquisition do not qualify as part of the cost of that item for which QCE is taken. In effect, such borrowing costs for tax purposes are required to be expensed in the period that they arise. Even though IAS 23 requires that are capitalized as part of the cost of the relevant item. So that I need to keep a recording of the cumulation of the borrowing cost, right? And the accounting carrying amount based on those cumulation, and the tax basis, which will exclude those borrowing costs, where those QCE qualified, rather, where those qualifying assets under IFRS were acquired or were purchased. But for those items that are constructed, the IFRS circular provides that all borrowing costs associated with construction of that asset should be capitalized as part of the cost of the item. In summary, it is only those qualifying assets that are constructed that will necessitate the capitalization of borrowing cost for the purpose of claiming capital allowance, because those items will be valid qualifying capital expenditure for the total, for the base cost and the associated borrowing costs incurred. That is the provision of the IFRS circular. In addition, an entity might have placed some fund to yield income while awaiting the disbursement or the using of the borrowing for the purpose of capitalization, for the purpose of acquisition or purchase or construction. An entity may take a loan and will not spend that loan. The loan may be used for 30 days, 15 days, or even for an overnight call, right? The interest accruable to that entity by way of placement is required to be deducted from the cost of, for the cost of that asset in arriving at the carrying amount under IAS 23. Such borrowing costs, such income are presented net from all the expenses required or associated with that qualifying asset. That is IAS 23. But under the Nigerian tax framework, in the SEC, it provides that any income made from placement on a borrowed fund subsequently deployed for the construction of a qualifying asset is taxed as an income on its own. Whether it's going to be taxed or withholding tax, is going to be taxed at source. So it is not considered, it is not ignored to be presented net for subsequent use. That portion of the interest yielded by placement of that borrowed fund temporarily will be subject to income tax. Also, our tax law recognizes the capitalization rate, that is the weighted average of borrowing cost. Our circular recognizes it. So the approach used in determining the capitalization rate, whether the general funding pool that from which a spending is done to construct an asset, is recognized under our tax circular. Recall, this is limited only to construction of qualifying asset, not purchase, not acquisition. This is very key. So these are the core provisions of the tax implication of IAS 23 borrowing cost framework with respect to income taxation in Nigeria. So these are the core provisions concerning these items. And the accounting provisions are be considered. So let's have this in mind as we go ahead to apply our IAS 23, ensuring that we ascertain what qualifying assets are. We know what borrowing costs are eligible. We know when to commence capitalization, when to suspend capitalization, when capitalization is to cease, and disclosure required with respect to IAS 23, and this tax provision, which limits borrowing cost recognition as part of the cost of an asset only when they are used for construction of an item that qualifies as capital expenditure under company income tax, Act, under petroleum profit tax for those entities still within the regime, under PIA, and the rest of them. So thank you for joining us for this episode of End of Day IFRS Spotlight with OJ Samuel. We want to invite you to subscribe to our channel, make comments, share our links, and get your other professional colleagues to join us in this journey of excellence in reporting and in professional practice. Thank you once again. My name is OJ Samuel. Bye for now.